So I think we'll go ahead and get started. Hopefully enough people have been able to join. Good afternoon, everyone, and thank you for joining us for today's webinar on Social Security benefits. So many people assume that they have to begin receiving Social Security retirement benefits as soon as they retire and stop working, but actually that's not the case. Retiring and claiming Social Security benefits are different, and you have options, and learning about them may help you make a well-informed decision about when to start receiving your benefits. So first, I'd like to take a moment to introduce your presenters for today. We're joined by Elizabeth Moffett from Burdett, Smith & Bish, CPAs and Management Consultants, based in DC. Thanks for joining us, Beth. Beth is a certified public accountant and a chartered global management accountant with over 25 years of experience in business. And my name is Fatima Iqbal. I'm an investment advisor and certified financial planner at Azzad Asset Management, joining you from Chicago. I'll be giving the main presentation, and then Beth will answer your questions during the Q&A. So let's get started. So as you approach retirement, when to claim your Social Security retirement benefit is one of the biggest financial decisions you'll need to make. Should you begin receiving benefits at your full retirement age, which is 66 to 67, depending on your year of birth? Should you begin receiving a smaller monthly benefit before your full retirement age, as early as age 62, or should you wait past full retirement age to receive a larger monthly benefit? And actually, you can delay receiving benefits up to age 70. As important as your decision is, there's of course no one-size-fits-all answer. It's a personal decision that must be based on your unique circumstances. Of course, sometimes the answer is simple. You may have to take Social Security benefits as early as possible if you're going to need Social Security income right away to meet your day-to-day living expenses, perhaps because of an illness or disability or unemployment. But if that's not the case, if you have other sources of retirement income, or if you want to continue working, for example, you'll want to take the time to make an informed, well-reasoned decision about your Social Security benefits. If you're like most people, you've paid into the Social Security system for years, and you'd like to get the most out of it. So I'd like to get started today with two major reasons why when you begin taking your Social Security benefits is so important. First, when you take benefits, it can significantly affect your overall retirement income. So with pensions disappearing, Social Security remains the major source of guaranteed lifetime retirement income for most Americans. Once you apply, your retirement benefit will be locked in for the remainder of your life, and in most circumstances, not counting annual inflation adjustments or recalculations to account for any additional work you might do. So it's important to take the time to explore your options now and help really make sure that you have enough retirement income later. The timing of benefits can also affect your spouse because he or she may be entitled to receive spousal retirement benefits and survivor's benefits based on the amount that you receive. There's a lot to consider as you make this decision. So here are some of the factors we're going to discuss today. Your full retirement age and how your benefit is calculated, the amount of your future retirement benefit and the effect of taking benefits early or late, how many years you expect to spend in retirement based on life expectancy, whether you plan to continue working, your other retirement income sources, your income tax picture, and how your decision will affect your spouse and the benefits he or she can receive. So let's start with a couple of basic things you'll need to know as you begin to explore your options. The first is, what is your full retirement age? It's the age at which you receive a full or unreduced Social Security retirement benefit. Your full retirement age changes from 66 to 67 depending on the year you were born, as shown in this chart. If you begin receiving benefits earlier than this age, you'll receive a reduced benefit. If you begin receiving benefits after this age, you will receive a higher benefit because you'll earn delayed retirement credits. Other benefits that you or your family members can receive are also based on what you're eligible to receive at your full retirement age. The second thing you'll want to understand is how your full retirement benefit is calculated. The benefit calculation is actually complicated and beyond the scope of the presentation, so I'm just going to give you a brief overview. Your Social Security retirement benefit is based on the number of years you've been working and your earnings over those years. To qualify for Social Security retirement benefits, you must have worked at least 10 years in Social Security covered employment. And when you become eligible for benefits at age 62, the Social Security Administration calculates your full retirement benefit. Your highest 35 years of earnings are indexed to adjust for inflation, and then they're averaged. Finally, a formula is applied to determine what your full retirement benefit is. And you may also hear your full retirement benefit referred to as your basic benefit or your primary insurance amount. If you retire at full retirement age, you'll receive 100% of this amount. But if you begin receiving your retirement benefit earlier, your benefit will be reduced by a certain percentage for each month your benefits come to you early. So let's take a closer look at how much you'll receive if you want to start taking benefits earlier than your full retirement age. Currently, the earliest age at which you can receive Social Security retirement benefits is 62. But choosing to take benefits early has financial consequences because it's going to permanently reduce the amount that you'll receive. Your benefit is reduced by a certain percentage for each month you receive benefits early. So if your full retirement age is 66, this equates to a 25% benefit reduction at age 62. If your full retirement age is 67, this equates to a 30% reduction. So here's an example. Let's say your full retirement age is 66 and you decide to apply for benefits at age 62. So your benefit will be 25% less than it would be at age 66. And as the chart shows, a $1,800 monthly benefit taken at age 66 will be reduced by 25% to $1,350 if you take it at age 62 instead. However, you'll receive benefits for a longer period of time, 48 to 60 months longer than if you began receiving benefits at your full retirement age. And of course, that's a big factor. We're going to discuss this soon, but first, let's take a look at how your benefit will be affected if you decide to delay retirement instead. If you delay receiving Social Security benefits, you'll receive delayed retirement credits that will permanently increase your benefit. Your benefit will increase for each month you delay receiving benefits, or about 8% per year, past your full retirement age up until age 70. Note that we're only talking about benefits based on your own earnings records. You won't be receiving delayed retirement credits for survivors' benefits or spousal benefits. To continue with the example from the previous slide, if your full retirement age is 66 and you decide to delay receiving benefits until age 70, your benefit at age 70 will be 32% more than at age 66. So as the chart shows, for each year you delay, an $1,800 monthly benefit taken at age 66 will increase by $144 per month and will be worth $2,376 if taken at age 70 instead of at age 66. This final chart shows the range of monthly benefits you might receive if your full retirement benefit is at age 66 is $1,800, depending on when you choose to begin taking those benefits. So in our hypothetical example, if $1,800 is the full retirement benefit at age 66, the monthly benefit of $2,376 at age 70 is 76% more than the monthly benefit of $1,350 taken at age 62. So that's a big increase. However, what this chart doesn't show is that you'll receive benefits for 8 years longer if you begin taking them at age 62 rather than at age 70. And of course, that can also add up to a lot of money. In this example, if you receive a $1,350 benefit for 8 years, you will have received $129,600 by age 70, which is not including any cost of living adjustments. So we return to the fundamental question, is it better to opt for a smaller monthly benefit at age 62 but receive it for a longer period of time, or is it better to take it at age 70 to receive the highest monthly benefit possible? So again, there's no one-size-fits-all answer, and in part it depends on how long you can afford to delay receiving benefits and on how long you expect retirement to last. So how long will retirement last? You know, there's no, of course, real way to know for sure, but retirement may last longer than you think. According to the Social Security Administration, about 1 out of every 4 retirees will live past the age of 90, with 1 out of every 10 living past age 95. So you may even want to plan for this maximum lifespan to reduce the risk that you'll live longer than you expect and just simply run out of money. For example, if you wait a few years to take benefits, you'll receive a higher monthly benefit for life. And remember, because you'll receive annual cost of living adjustments if prices rise, your benefit will generally keep pace with inflation, unlike most other sources of retirement income. And if you're married, you'll need to consider the joint life expectancies of you and your spouse, which will often differ from your individual life expectancies. If you're thinking about working well into your 60s and 70s to increase your retirement savings, you may be wondering whether you can receive your Social Security benefits while you continue to work. And the answer is yes. Many people choose to apply for Social Security benefits before they actually retire. But as you may have heard, earnings from work may affect your Social Security benefit if you're under full retirement age. If you're under full retirement age and your earnings exceed a certain amount called the annual earnings limit, part of your benefits will be withheld, reducing the amount you receive from Social Security. But once you reach full retirement age, you can work and collect full Social Security benefits, and earnings from a job won't affect your benefit at all. If you're under full retirement age, the rule is that $1 in benefits will be withheld for every $2 you earn over the annual earnings limit. This limit generally changes every year, and in 2016, the limit is $15,720. In the year you reach full retirement age, a special rule applies. $1 in benefits will be withheld for every $3 you earn over the annual earnings limit, and in 2016, this limit is $41,880. And as mentioned earlier, at or after full retirement age, earnings are actually not affected. They don't affect your benefit. However, I want to clear up a misconception. You're actually not losing your benefits because you choose to work, so you don't need to try to limit your earnings. If some of your benefits are withheld, you'll receive a higher monthly benefit at full retirement age because the Social Security Administration will recalculate your benefit every year, and they'll give you credit for any of those earnings that are withheld. So the effect of working that will have on your benefits is only temporary, and adding additional earnings you have may actually increase your benefit later. One of the most important factors to consider as you decide when to begin taking Social Security benefits is how your decision will affect your overall retirement income plan. So most people have several sources of earnings for retirement and retirement income, including your Social Security benefits, earnings from a job, pension benefits, and income from savings and investments. How much retirement income do you need, and how does Social Security fit into that plan? If you have less than adequate retirement savings or no pension, you may need to rely more heavily on your Social Security income, which would lead you to take benefits early if you need retirement income as soon as possible, or conversely, encouraging you to postpone taking benefits so that you can earn the highest possible benefit. But if you've been able to accumulate substantial retirement assets, you may have more flexibility when it comes to timing those Social Security benefits. So, for example, it's possible that taking your Social Security benefits sooner than later will allow you to delay withdrawing funds from tax advantage investments, such as your 401k plans, 403b plans, or your traditional IRAs, and allow them to accumulate tax deferred a bit longer. Alternatively, tapping other retirement assets first may allow you to postpone claiming Social Security benefits, thereby allowing you to accrue delayed retirement credits. Taxes may also be a consideration depending on what income you have in addition to your Social Security benefit. Now, taxes aren't going to be a big concern for everyone. If you have little or no income other than Social Security, then your Social Security income generally won't be taxable. But if you have income from sources other than Social Security, you may end up having to pay federal income taxes on your benefits. So as shown on the chart, 50% to 85% of your Social Security benefit may be taxable depending on your combined income from Social Security and other sources and your tax filing status. So for example, let's say you're single and you collect a Social Security benefit of $20,000 per year and have $35,000 in earnings from a job. So up to 85% of your benefit may be taxable because your adjusted gross income plus 1/2 of your Social Security income is greater than $34,000 per year. It's important to remember that when you're making your decision about when to begin receiving your Social Security benefits, federal and in some cases state income taxes may be a consideration if you have substantial taxable income such as earned income, taxable pension income, or investment income. If you're married, there's another important question you'll need to ask before you decide when to begin taking your benefits, which is how will my decision affect my spouse? And that's because when you begin taking your retirement benefit, it can dramatically affect your spouse's benefit during retirement, and thus your household income. Your decision can also affect any survivor's benefit your spouse may be entitled to, and your spouse has decisions to make too. Together, you'll need to consider what the most appropriate combination of claiming ages is based on your ages, earnings, and life expectancies. I want to point out here, too, that other people, such as your dependent children or a former spouse, may also be eligible for benefits based on your earnings record. But the rules are a bit different, so we're not going to cover them in this presentation right now. When you're married and both you and your spouse have worked in jobs covered by Social Security, each of you may be entitled to retirement benefits based on your own earnings record. As you recall, at your full retirement age, you're entitled to receive 100% of your full retirement benefit, and you can receive reduced benefits as early as age 62. You or your spouse may also be entitled to spousal benefits. So for example, if your spouse has had low lifetime earnings, he or she may be entitled to a spousal benefit based on your earnings record that is larger than a retirement benefit based on his or her own earnings record. At your spouse's full retirement age, this spousal benefit will generally equal 50% of your full retirement benefit. However, that amount will be reduced if your spouse files early. So for example, if your spouse's full retirement age is 66 and he or she files at age 62, your spouse will actually receive only 35% of your full retirement benefit amount. And this reduction is permanent, so it's important to carefully consider the implications of filing early. And keep in mind that your spouse can't collect spousal benefits until you have filed for your retirement benefits. And in addition to retirement benefits and spousal benefits, married couples must consider survivor's benefits. So when taking your Social Security benefit can greatly affect the amount of income available to your spouse should you die, because your surviving spouse will generally receive the benefit that you were receiving at the time of your death, unless your spouse is already receiving a higher benefit based on his or her own earnings record. If your spouse's life expectancy is much longer than yours, this can be an especially important point to consider. Survivor's benefits may be payable as early as age 60. However, a benefit reduction will apply if the surviving spouse begins collecting a survivor's benefit between age 60 and his or her full retirement age. Here's a hypothetical example that illustrates why it's important for spouses to carefully choose when to begin receiving Social Security retirement benefits. In this example, both spouses are able to claim benefits based on their own records, and spousal benefits are not considered. As this table shows, if both spouses choose to take benefits at age 62, their joint monthly income will be $2,784. But if both spouses wait until age 70, their joint monthly income will increase to $5,241, which is a difference of $2,457 per month, and that's almost $30,000 per year. In addition, by waiting longer to take retirement benefits, spouse one may also generate substantially increase actually spouse's their monthly survivor's benefit, since Social Security generally pays the surviving spouse the larger of his or her own retirement benefit, or the benefit his or her spouse had been receiving. Of course, the illustration doesn't take into account the other factors that this hypothetical couple might need to consider, and of course, your own situation and overall income plan will be unique. You may have heard that new rules included in legislation passed at the end of 2015 effectively eliminated Social Security claiming strategies that couples used to use to maximize their Social Security income. However, one of those claiming strategies is still available to some individuals who are grandfathered in under the old rules. So if you were born on or before January 1st, 1954, and meet certain requirements, you still potentially have a limited window of opportunity to take advantage of a claiming strategy called filing a reduced application for spousal benefits. This strategy allows you to collect a spousal benefit at full retirement age, then later collect your own worker benefit. However, the strategy typically works for those who still qualify, and assume that you're eligible for Social Security retirement benefits on your own spouse's earnings records, then on your own earnings record. Once you reach full retirement age at age 66, you may opt to file a restricted application for spousal benefits if your spouse has already filed for his or her own worker benefit. This allows you to collect spousal benefits and postpone receiving your own worker benefit in order to accumulate delayed retirement credits on your own benefit. And this may help you maximize your joint Social Security retirement income because delayed retirement credits will increase your benefit by approximately 8% for each year you wait, up until age 70. This strategy also potentially increases the survivor's Social Security benefit should the higher earning spouse die first. So remember, upon the death of a spouse, the surviving spouse is generally entitled to receive the greater of his or her own benefit or the benefits his or her spouse was receiving. And here's an example to illustrate the concept. So one spouse, let's call her Diane, first files for retirement benefits based on her own earnings record. And then at his full retirement age, the other spouse, let's call him Mike, files a restrictive application for spousal benefits based on Diane's record. Then later at age 70, Mike switches over to his own benefit, which is now 32% more than it would have been at full retirement age due to delayed retirement credits. By using this strategy, Diane and Mike have increased their joint monthly Social Security income and have potentially increased the survivor's benefit available to Diane, assuming that Mike dies first and that his benefit was higher than hers. Again, filing a restricted application isn't available to everyone anymore. And remember, you have to meet certain requirements. You must have been born on or before January 1st, 1954. You can only use the strategy once you reach full retirement age, which is age 66, and your spouse must already have filed for retirement benefits based on his or her own earnings record. But even if it's an option, the restricted application strategy isn't right for everyone. And you'll need to consider factors such as age differences, benefit differences, other sources of retirement income, your life expectancies, and income taxes when deciding whether to use the strategy. Today, we've looked at some of the major questions that you'll need to consider as you decide when to begin receiving your Social Security benefits. And to recap, here are some of the reasons you may decide to take benefits earlier, as well as some of the reasons why you might decide to take benefits later. Remember, the choice is really yours, and it's up to you based on your unique needs and circumstances. As a starting point, if you haven't already done so, I'll urge you to go to the Social Security website, where you have a couple of relatively easy ways to estimate what retirement benefits you might receive. First, you can sign up to access your Social Security statement online so you can view your actual earnings record and what you could expect to receive from current law if you apply at age 62 at full retirement age and also at age 70. And if you're already age 60, you also have the option of receiving that statement in the mail every year, which is extended to about 3 months before your birthday. The second way to estimate your Social Security benefit is to use the SSA's retirement estimator, which is also available at the SSA website. And this calculator can allow you to input various scenarios based on the current law to estimate your future benefits. As you near age 62, you should also contact the Social Security Administration to discuss your options. Representatives are not really allowed to give you advice on when to start your benefits, but they do help explain your options and the rules that apply. When it comes time to apply for Social Security benefits, you can actually do that online, by phone, or in person. So that concludes the main presentation for today. I'll get to your questions in a moment. But first, if you're approaching retirement and would like to have a financial consultation to determine your best course of action, please feel free to contact me or one of my colleagues at Azzad. And if you have questions about your personal or business income tax and you're not currently working with a CPA, you can also contact Beth to schedule a half-hour private consultation to answer your questions and talk to her about her firm might be able to help you in tax planning. So now we'll open up for questions. You can type your questions in the Ask a Question box on your GoToWebinar dashboard for that. And I'm going to be directing the questions to Beth. So please go ahead and start typing your questions in the box, and we will start getting those answered. So Beth, the first question that we have, a person is asking, I have a retirement account and I'm still working. I'm already 70 years old. My spouse is 10 years younger than me. What happens if I never end up tapping into my Social Security?
Well, I would say the individual probably is, if they're already 70, they're not going to increase their benefit any further by delaying any further. So they should go ahead and start applying for their full retirement benefit at this point. There's no benefit to delaying other than the loss of monthly income. The spouse is in a different situation, and the spouse is obviously not eligible yet for spousal benefit if they're 10 years younger. So that needs to be looked at as to when the date that the spouse begins to take would depend upon what their own income, working income was, and what their benefits, potential benefits are.
Okay, so again, there's no benefit really in delaying your Social Security beyond age 70, since that's the maximum. At what point you receive the maximum benefits? It won't go up after that point.
Right.
All right. Next question: if you make a higher salary after age 62 than during your top 35 years, will this increase your Social Security benefit if you delay? Good question.
Yes, definitely. If you want to look at your Social Security earnings record, and since it calculates based on your highest earnings over 35 years, then if you have a year that and you continue to work and earn at your highest level, which is common, certainly you'll be adding to your potential Social Security benefit in retirement.
All right. So again, please go ahead and ask any questions that you have.
If we don't have a question, okay, I might pose one that often comes up. It's usually the first question out of the mouths of any one of my clients when they ask is, will Social Security still be there when I retire, if they're, say, 10 years out from retirement? And there are actually a lot of great projections online to kind of look at that and sort of figure out what Social Security fund is going to look like. And depending upon your assumptions about how many working people there will be and what the economy looks like in the next 10 to 15 years, the average looks at the potential difference between money coming in for Social Security payments from current workers versus money flowing out to retirees. That balance will begin to shift in about the year 2033. So up until 2033, at least, we have more money coming in than money flowing out. After that point, it may shift. That doesn't mean that we run out of Social Security funds. It just means that there may have to be at that point some kind of shift in how the Social Security is structured. Whether that means a delayed retirement, perhaps Congress could decide to push the retirement dates out even further. They've already done that by increasing the average retirement age up now to the full retirement age up to age 67, depending upon when you were born. Could be that the age 70 becomes the full retirement age at some point. So at this point, I don't think there's any projections that think that Social Security will run completely out of money, so that there won't be any Social Security available for the current workers. But it's the question of how that will be structured and how our tax system will be structured is very much up in the air 20 years out from now. So.
Okay, and actually that addressed one of the questions one of our attendees asked is, with, kind of this fear of, is Social Security going to run out? Do I need to take it as early as possible? And if you're nearing retirement right now, then that's not necessarily the case. It seems like at least for now we have Social Security in place, especially those that are nearing retirement. So another question that we have here, are Social Security survivor benefits for children considered taxable income?
That depends upon that's subject to, again, to the same rules of what other income is there available to the individual who is receiving the benefit. So if they're receiving Social Security benefits, they have to look at the whole tax picture to calculate what is taxable of the Social Security.
Okay. Okay. And we have a question. My spouse is 4 months older than me. Can I start retirement age at age 62 and my spouse delays it? So even though, I'm younger, like this attendee is asking if I'm younger than my spouse, can I still start at retirement age and my spouse delays? Or does it have to be based on age older?
Again, it's still the same rules about early retirement. So your own retirement age, the earliest that the individual could begin to take Social Security is age 62, regardless of the age of the spouse. But the amount of benefit that each would receive is determined by what the individual age is of the individual and their spouse. So the benefit is determined by that, but the eligibility age still continues to remain 62 as the earliest, and then 65, 66, 67 would be full retirement age for either of them. I'm not sure if I'm answering that question.
Another question that we have is, it looks like it pertains to medical benefits. If somebody, is your eligibility for Medicare tied in any way to when you start taking your Social Security benefits?
No, actually, Medicare starts at 65 regardless. That stays the same. That hasn't changed. So that's different from the Social Security benefit.
Okay. Another question, and I think we were just talking about this before we started the broadcast. So this person is asking, is Social Security taxed by my state? And, are there good states, quote unquote, to be in when it comes to state taxes?
And absolutely, every state has a different treatment of Social Security. So many of the states, probably about half the states, do not tax Social Security benefits. Some of the states tax Social Security benefits only partially, or some states don't tax income at all, so there is no state tax on Social Security either. So you have to look carefully about that issue when you're planning for retirement to determine where you want to live. Affects your overall tax picture, and state taxes are an important component of that.
Okay, so your income is one factor that can affect how your Social Security retirement benefits are taxed, and also your state income tax rules are another factor.
Right.
Okay. Another question, along with Social Security, in what order of priority would I draw my money? From retirement funds first or personal savings? So, retirement funds, again, being tax deferred. Personal savings, are not tax deferred. They're taxable accounts. And then Social Security, again, we just talked about some of the tax consequences. So any general suggestions in terms of priority, what would be a good idea to consider?
That is very much an individual answer, and you do have to look very carefully at all the possible sources of income in retirement to determine how best to draw on that. One of the mistakes that I've seen people make is if they have a tax-deferred account, such as a 401k or thrift savings plan or IRA, that they start retirement and they pull the full amount out of that retirement account the first year, and then put it into a taxable account. Now what you've done is you've turned that entire tax-deferred account into taxable income in a single year. So the actual rate of tax being paid on that income is very, very high, and possibly at the highest level, as opposed to spreading it out over several years. So good tax planning would involve looking at all the potential sources of retirement income and then deciding what amount of money do I need each year, and how do I draw on the various sources to ensure that I minimize my tax over the long haul.
Okay. Another question from an attendee. I work, but my salary is much less than my husband. Now my husband has reached the full retirement age, but I have not even reached the minimum age of 62. If I take survivor's benefit now, will it affect my Social Security amount if I take it at full retirement age later?
I don't think the spouse would be eligible to take the spousal benefit until they reach at least age 62, even though the spouse has reached full retirement age. Not certain about what they would be eligible for, but it won't affect their ability to draw on their own Social Security at full retirement. But it does affect the timing is important on when they start drawing that survivor benefit. So they need to probably contact Social Security and just determine what are their benefits and what will their benefits be at the various ages to ensure that they get the right number to make a good decision.
Okay. And the next question is again about the restricted applications we discussed in the presentation, also known as file and suspend, and there was legislation that was enacted that has changed that. So can you kind of go over again exactly what has changed, and for those that are eligible, again, do the previous rules still apply for them, those that have been grandfathered in?
No, there were a number of major changes that happened depending upon the age of the individual. There was one provision that expired this spring for individuals who had birthdays prior to, I believe it was April 30th of 2016, if they reached 65 by that age, they could file and get a particular a special benefit, spousal benefit. That went away, so that's no longer available. But there is a different part of that component that you talked about in your presentation that needs to be looked at, and it's very individual based on the individual's ages, both spouses' ages, and what they're eligible to take. So they'll need to look at that carefully on an individual basis.
Okay. The next question about what is the minimum earning to be eligible for Social Security income? So in the presentation, I talked a little bit about the minimum credits that you need to work about 10 years in order to earn those credits to have your own earnings record. Now, for somebody, is there a minimum amount that they have to earn to be eligible for Social Security income? And does somebody need to have any earnings record to have any spousal benefits?
So an individual who's never been married would need to have at least 40 quarters, or basically 10 years of work life, even on a part-time basis, to be eligible for Social Security at even a minimum level. An individual who is married and who has never worked outside the home would have to rely on their spouse's benefits. So, for example, if the individual, if we're talking about a wife who's been a homemaker all of her life, it's her husband's Social Security benefits that she would be relying on as spousal benefits when she reaches full retirement age.
Okay.
Which wouldn't have her own earning record to count on.
Okay. So either you have your own earnings record that you pull from, or you pull from your spouse's earnings record, which would of course not be the full amount that you would get. You would get a reduced amount based on your spouse's earning income.
Right. But income. There's not a minimum dollar amount. As long as you had at least a few $100s of earnings in any one quarter,
okay,
then it would count towards Social Security earnings. And I want to say that's probably $600 or something like that, mm-hmm. to have the minimum amount, and that has changed each year. But it's important to look at the Social Security record to determine if you have enough earnings on the record. Mm-hmm. Sometimes there are mistakes. W-2s get filed under the wrong Social Security number or something like that, and before you reach retirement, you want to check that record and make sure that you have a full 10 years of Social Security earnings to be eligible.
So again, anybody can go to the Social Security Administration website and check and see what your records are there, and you can get a hold of that so that you can start thinking about, what decisions that would be good for you. Any last questions, please go ahead and type them in to the box.
Well, while we're waiting, if there's anyone, one of the questions that didn't come up that I've heard expressed is what happens if someone has multiple spouses? They marry and divorce, and what happens to their Social Security benefit? And in fact, if those spouses never remarry, they are all still eligible for taking Social Security benefits based on their spousal benefit of the former husband. So, for example, if a husband had 5 or 6 wives, not that that happens, but each of those wives would be eligible to take Social Security based on the husband's earnings as long as they do not remarry. Okay. So it's kind of a quirk of the code that can allow multiple spousal benefits.
And another interesting question, maybe I'll pose out there, that I've been asked the scenario that if you are a widow, maybe twice widowed, for example, you were married, your husband passed away, your wife passed away, you remarried, that second spouse passed away. How does that affect your Social Security benefits? That's a good question. It's going to be the last spouse that you married. So if you are receiving spousal benefit and you remarry, you're going to lose that spousal benefit, and I believe it goes to your last spouse. Okay. It's the person that you're drawn. So it could affect. So it's something that you need to be mindful of, and when we have
folks in their retirement who are remarrying, many times have to consider that. How is this going to affect my Social Security?
Okay. A question, do I need to choose between my own benefit or my spousal benefit? Yeah, that's...
Well, I believe Social Security has told me when I've talked with the folks there that they are supposed to automatically adjust to the higher amount, whatever it is. But that they don't always know. Their records may not be up to date. So that's something that you need to be careful and check and make sure you're getting the highest possible benefit.
All right, and I think one last question. Again, somebody just wanting to clarify again, they can, if they start their Social Security at 62, but their spouse can still delay there. So if one spouse starts taking, the other is not required to start taking, they can delay taking benefits later.
Right.
Okay, all right. Well, with that, we will wrap up the presentation. We'd like to thank you, Beth, for joining us on this presentation. And to all of our attendees, we hope you found this informational and useful. We'll be sending out a link of the recording to anyone who missed this. But thank you again for joining us, and have a great day.
Thank you. Goodbye.
Bye.